Okay. All right, everybody. Well, thank you very much. We see that we have several attendees coming in. There are some more joining right now, so we just wanted to give a couple moments for some more to join, but we're really excited to begin. This is part of our series of our kind of economic updates series, just trying to hear different opinions and hear various thoughts from different worlds of what's going on and how that pertains to us in our world of investment management in general, and specific to real estate, and even more specific to what we do in multifamily. But we find that, when we hear from all kinds of different realms of the financial world, it's helpful. So really excited to have our guests, panelists with us today. Without further ado, I do want to introduce them. But first, I just want to remind everyone that there will be a Q&A at the end. Would love to have some questions, and you can just drop those questions in the chat, and the team will be sure to shoot them over, and we'll do our best to try and get to everybody's questions. So thank you very much. I'm Daniel Farber, the CEO of HLC Equity. We're a real estate investment company, or multi-generational company, and we're excited to have with us Loretta Clodfelter. Did I say that correctly?
You did.
I got that correctly. Very good. And Chris Osmond with us today, and I'd like both you to introduce yourselves, please. So Loretta, please.
Hi, I'm Loretta Clodfelter. I am senior editor of Institutional Real Estate Americas. That's a monthly publication published by Institutional Real Estate, Inc. We have 4 different sort of verticals that cover real assets investing for both institutional and family office high net worth investors. So my specific area, institutional real estate, focuses on our real estate platform for an institutional audience of institutional investors, their consultants, the fund managers and investment managers who serve them. We also have our infrastructure publication, which does the same thing for the infrastructure side. And then we also have our Institute for Real Estate Operating Companies, IREOC, which does that for the operator side of things. And then we have our Real Assets Advisor, which is aimed at the family office high net worth audience. And we do daily newsletters, monthly periodicals, and conferences and events for each of these platforms.
Very good. Okay, thank you. Thank you. Chris, please introduce yourself.
All right.
Good to have you here.
Yeah, thank you for having me. I really appreciate it. So Chris Osmond, I'm the Chief Investment Officer for Centura Wealth Advisory. We are an RIA, or registered investment advisory, an advisory firm headquartered out of San Diego, California. We primarily look to add exponential value for our clients that are typically high net worth and ultra high net worth investors. And they typically have one or all the following 3 profiles. They are high income earners making over $1 million a year in AGI, or annual adjusted gross income. They've had a money in motion event. So we classify those as the 4 Ds: death, divorce, disposition of a real estate asset without a 1031, and disposition of a privately held business. And then the third would be those with a taxable estate. So 12 million for an individual, 24 million for a married couple. We take a more of an endowment model approach when it comes to asset allocation. So believe in a heavy utilization alternative investments, because we believe they also provide exponential value to an investor's overall portfolio. So that will consist of mainly the 3 major food groups of private equity, private credit, and of course, private real estate.
Okay, very good. Thank you. Well, we're again very excited to have both you here, and we appreciate it. And when we think about the real estate field, it combines many components of the economy, obviously, and it's largely driven by macroeconomic factors. And so, as our topic is, it's interest rates and inflation are definitely top of mind, and they greatly impact these factors. So that's really the focus of our discussion today. And again, it's part of a series where we also have white papers and articles that we're putting out, and our team is working hard at researching as much as we can to try and stay as informed as possible, and also to inform our crowd, which includes our investors, partners, and just general, people that we like to associate with. So let's get right into it now. Let's talk about the current landscape. I can talk about it from where I'm coming from every day, looking at real estate deals, managing real estate, but really I'd love to hear from the two of you kind of, from your mindset, where we are from, even if we go from the Great Recession to, where we are today, including, leading up to the pandemic, it would be great to hear both of your guys' where it's coming from, but specifically, Loretta, if we can start with you, I'm really interested in terms of, day to day, what you see and what you hear on your various platforms, because really you have a few different platforms that you kind of hear the points of view from. So I'd be interested to hear.
Sure. One of the things that I think you mentioned that inflation and interest rates are top of mind, and that is 100% true. I've talked to a lot of our readers. We have an editorial advisory board made up of, institutions across the institutional world. So pension funds, endowments, insurance companies, et cetera, as well as real estate investment managers. And inflation continues to be sort of the #1 topic that everyone has been talking about for at least a year now, it seems. And the rise in interest rates, very relevant to everyone's questions. I think if you want to talk about how we got here, 100%, this is driven by the pandemic broadly, whether that is, sort of immediate reaction to the pandemic and efforts to stave off a recession in the wake of COVID-19, or the supply chain issues that we're seeing that are also being driven by reactions to COVID-19. This is all still coming out of the pandemic, and we're still, this is COVID's world, and we're just living in it.
Right.
Okay.
Loretta, I would even add in terms of how we got here going pre-COVID, right? And going back to the heels of the Great Recession, the financial crisis, and at the time was astronomical support by the Federal Reserve of tune of 880 billion of monetary support, through asset purchases and so forth. Well, really, since then, the Federal Reserve has done nothing but almost shoot steroids into the arm of the economy, which has distorted the perception of asset prices as well as risk. And it's also helped push asset prices higher than perhaps the real value is. And what we're seeing now, I think, is the market tends to have a way of correcting itself, and it's doing just that, right? It's now going to put things back into realistic terms.
Okay, thanks. Yeah, so it's interesting because as you guys are talking, I was also thinking about from the real estate perspective, Great Recession. Then the economy starts taking off in large part due to stimulus that had been back then historic, and nobody had ever seen stimulus of that sort. Flooding the economy with capital, and then everything looking so heated. So then when I think to 2015, we were buying multifamily properties in places like Dallas, and thinking that, oh my goodness, these 6.5 to 7 cap multifamily properties, it's crazy. How could you have such low cap rates? And then 2016, I remember sitting with one of our institutional partners and then being like, you're buying this stuff in Denver for a 6 cap. Aren't you scared? I mean, something is going to happen. And my answer naturally is always, yes, I'm always scared. But that's because we try to be ready for all circumstances. But then, so you think about how it kind of progressed, and it seems so hot, and it constantly seems so hot, and eventually there's going to be that that perfect storm that's going to tip everything over, and then a pandemic comes, and that's obviously the perfect storm, and it doesn't necessarily tip everything over the way that like at least we experienced during the Great Recession, and in large part that's due to government putting more money into the economy and so on and so forth. Obviously there was a lot of tragedy around pandemic, people being sick, shutdowns, businesses being lost. I'm not, trying to minimize that whatsoever. But so, like when you kind of take it through, it's just, in my eyes, really interesting, because now we're at a point where, we've been through that, and now, so what could be worse than a pandemic? Well, obviously a pandemic and a war would on a global scale would make it worse. And then it didn't necessarily seem that it would. And we're going to get into it in terms of where we are. But I think that just kind of leading up to it, that's kind of, how we see that things just incrementally got more and more kind of like more scary. Something could happen. Nothing's happening. We never take that approach of this time it's different. So it's like, where is it going to come from? and like the worst scenarios have happened, and it had, and maybe this is, and maybe it isn't, because I think that we're going to get into some, some numbers when you look at GDP and so forth that, may kind of say otherwise. So, but that's, I guess, kind of leading to where we are now, which is, the current landscape. So, yeah, please.
I was gonna say, reflecting on what you were saying, in 2019, the biggest concern that investors had was, where are values? Are they too high? Are we, are we headed for some sort of downturn in pricing? Values seem very high. Cap rates were very compressed. That's 2019. And then of course we have this recession kicked off by a global pandemic. And, there was a lot of maybe people kind of taking a pause in 2020, but we didn't really see values slip, especially in certain property types, industrial multifamily in particular, held strong. Investors wanted them. And so, we've kind of come through this very devastating global health event with real estate in the same position. And I'm hearing investors say stuff like the multifamily market is priced to perfection, which always sends a little bit of an alarm bell.
Right. And so, like, I remember that term being used in 2018, and it probably was. The fact of the matter is, but apparently, not everybody, I guess the world did not feel that. So, so it's real. Chris, were you going to say something?
Yeah, no, I was going to say, I think one of the things that's helped also support asset prices is you look at recessions in the past, and they've been caused by financial crisis. This was not caused by financial crisis, right? Yeah. We use the same tools, I'd say, at an exponential rate that we use to fight financial crises between both fiscal and monetary stimulus, but it was indeed a humanity problem, right? A global pandemic, and not a financial crisis, which is why I think when everything opened back up, you saw asset prices just propel higher. And in looking at real estate, you saw cap rates get compressed more. And while input prices and cost of raw materials, skilled labor were going up, right? The underlying price, people were willing to overpay even than what perhaps that perceived intrinsic value or that price to perfection value was, and hence push asset prices higher.
Well, and rent growth, at least in the past 2 years, has supported those values. The question remains, and I think this is the $1 million trillion question, is, how much higher can apartment rents go before we start running into real affordability issues? How much more can renters pay? Because what are rents up 14% in the last year? Some markets in the Sun Belt, it's 20 to 25%. Florida is on fire, in a good way.
Right. We purchased a property last year in what some would consider a tertiary market outside of Dallas, and our projected rent growth was 6%, and we've exceeded 20%. And that's a function of the market, of operations, of a bunch of different stuff. But it definitely speaks to what you're in. Again, these affordability questions we were asking in 16, 17. And so, at a certain point you hit a cap. Where that is exactly, I don't know. Wages have gone up because it's just there's no other choice, and it's because of all kinds of different labor issues and so forth. So going into kind of where we are today, and this touches exactly on what you're talking about, which is housing shortages is a major item, right? There are several different items. There's housing shortages. There's rates, if they'll continue to go up, inflation, and so forth. Just to read off a couple bullet points here. So current U.S. housing inventory is estimated to be 3 million short of demand. Housing starts are up 13.5% from a year ago levels, and 24.6% from the beginning of the pandemic. And build timelines are prolonged due to supply chain disruptions. So that's providing for little relief, and there's unprecedented low vacancies and increased rents, like you were saying, 15.3%, depends who you ask. So that obviously that takes down people who would be buyers. So that's just I think a couple notes on what you're talking about. But I'm curious to hear from you guys, kind of, you know, if there are other factors in terms of both rates and what you're seeing, especially Chris. I'd be interested in the financial kind of like with the wealth management stuff that you do, maybe even outside of the real estate space, what you're seeing in terms of the impacts. And you mentioned before about the stock market, but I was just reading, you know, basically the S&P is back to where it was, and correct me if I'm wrong, this is as of 2 days ago, was at where it was a year ago. Right.
Yep.
So it's a correction, but you know, that it could be, you know, very well be a healthy correction in general, because you're not talking about a drastic 2008 type scenario. So I'm curious what you're seeing in terms of where we are today.
Yeah, you know, it's definitely interesting, especially when you look at the equity markets. And you know, I know I've mentioned you know, monetary policy, but if you look at the Fed's balance sheet, right, it ballooned for more than $4 trillion during the pandemic. It sits just below 9 trillion. They haven't started reducing it yet. But you look at the correlation to the S&P 500, and it's 0.91. Okay, and so when that starts to reduce, you can expect that the S&P 500 will also reduce, and that same correlation with M2 money supply also exists within the S&P 500. So equity prices, I would say, you know, they tend to be forward, you know, looking indicators, and so some of that may be priced in, but there is also some cause for concern as you know, even moving forward. You look at like what happened in the first quarter GDP. And you know, expected to come in at a positive 1% and came in at 1.4%. And when you start looking under the hood, yeah, the consumer's still spending pretty strong. You know, it grew 2.7%. There's 70% of the economy. But when you look at government spending, you know, you have a defense spending went down almost 9%. Then you have government spending, the deficit is the lowest it's been in 3 years, and it's $1 trillion. So it's over 3 trillion in 2020, almost 3 trillion again in 2021. And so now it's almost fallen off a cliff in terms of support. So that impacts investment spending. Inventories are depleted, and so that's also impacting it. And then you have a trade imbalance, a trade deficit that's also reached a record high of over $1 trillion, because the US dollar is also at a 20-year high. You know, so it's really crazy. I almost wanted to wear tie-dye today, because when you look at a lot of things that are going on at the highest inflation back to the 80s, you know, you start seeing a lot of similarities of occurrences that haven't happened since the early 80s. And so it's a really hard dynamic to manage from an asset allocation perspective, because when you factor in there, interest rates are rising. And for the first time ever, this is ever, both the bond market, so the Barclays aggregate index, and the S&P 500 are correcting at the same exact time. They both corrected before, but simultaneously be correcting. Typically, you have bonds to serve as a ballast in your portfolio for public markets. That's just not happening, right? So there's really nowhere to hide except for commodities, you know, for the whole entire, you know, year to date anyway. And so it's just really interesting and difficult to navigate. You know, fortunately, you know, we kind of came in a little bit more conservative into the year, and I hate holding cash, but you know, even the loss of purchasing power year to date, it outweighs the loss on bonds and stocks. So it's actually been a good, you know, addition to hold a little cash right now in our portfolios. But we're also really glad that we've been heavily allocated to alternatives, primarily real estate. That's been our largest allocation, and primarily multifamily. And so we've been very fortunate. Our clients have been very fortunate to really benefit from the growth seen there in those markets. The one that we're most concerned about, not necessarily concerned, is, you know, private equity. You know, they're just like tech stocks, right? They're correlated to interest rates, because when you start discounting future cash flows back, that hurts the valuation. And so if I'm in a private equity fund and my manager is deploying capital right now, I'm pretty happy, right? Because odds are they're getting companies at a discount where they were perhaps, you know, 6-7 months ago. But if I'm already done with my investment period and I'm looking to sell companies, you know, I may be, you know, an investor that's rooting for that extra 2-year extension.
Right. That's really interesting. So you mentioned before, in terms of the allocation to real estate, is that through the private market, or are you talking about about
Yep.
buying?
Yeah. So we primarily access real estate through the private market.
Okay. Which markets are you finding most attractive now from a investment standpoint in the multifamily space?
You mean geographically?
Yeah, geographically, yeah.
Yeah, so right now, a lot of our, being West Coast headquartered, right, in San Diego, a lot of our exposure is along up and down the West Coast in Washington, Oregon, California, and a little bit inland into Nevada, Arizona, and just as recently in Denver. And we're currently searching for those in new operators in the in Midwest as well as in the Sun Belt region.
Okay, cool. Yeah, well, we'll have to make the push to the Sun Belt because everything is sunny down there.
Yeah, I actually live in Florida, so yeah, I can attest to some of the growth that Loretta mentioned with regards to rent growth and just overall house prices.
Yeah, definitely. Okay, great. So Loretta, maybe you could tell us a little bit just in terms of what you're seeing in terms of where we are currently, based on the research and the insights that you get from your guys' client base.
Sure. Kind of building off what Chris was saying, some of the, one of the big issues continues to be where do you invest, given that, equities are where they are, bond market as well. And so, yes, alternatives have over even the last decade have become a larger and larger part of investor portfolios and specifically real estate. We see, we do an annual survey of investors and we see, allocation to real estate, private real estate, hovering somewhere around 9 to 10% as an overall portion of portfolios. And if anything, it looks like that's going to go up in the next year. And, for the most part, investors have not even reached their target for that. So they're still below target. So they're still trying to put money into real estate. The denominator effect, as we talk about, so how much of your overall portfolio goes to real estate definitely gets affected when stocks go on a tear or when they do a pullback. So, I wouldn't get too far out as far as what we're going to see, but we expect from our survey about $100 billion to be put into private real estate from institutional investors in the year ahead. And when we ask them which property types, it's probably no surprise if I tell you that number one is warehouse distribution, but in the top 5, you're also seeing biotech, life sciences, and market rate multifamily. Those are really sort of the things that investors are most interested in. The other kind of traditional core property types, office, retail, no one wants to invest in them right now. There's just too much uncertainty about what's happening both with office and with retail. And so it kind of makes the apartment sector a lot more attractive because when they talk about the sort of investment drivers, when you talk about the fundamentals supporting apartments and residential more broadly, single family rental is also very popular with our readers. The trends supporting it, they're just, you mentioned already the undersupply of housing. That just creates an overwhelming attractiveness to kind of push what's happening there. And then the other thing that we really haven't gotten into yet, but should definitely address is supply chains and the high cost of construction. I believe it's up about 10% year over year, cost of building a new commercial property. And if you think about that, have rents grown enough in the last year to support that? Yes. Will they grow that much in the year ahead to support that? Open question, TBD, we'll find out, but it definitely means that we're going to see less supply growth than we might otherwise, which for, owners of existing properties continues to be a positive support for the market.
Yeah, 100%. And so something that we're asking all the time is so that there's definitely, without a doubt, undersupply when it comes to housing, both on the apartment side and in terms of single family homes. And we're in this weird scenario where in most attractive markets, cap rates are below the cost of debt, which is somewhat unprecedented. It doesn't make any sense from a real estate standpoint. Something that I'd say that as a very broad statement. There are places where you can find it, and if you know how to find the right properties, you can find properties that make sense where you are able to get enough margin between the cost, of the property, the yield on cost and debt, but it's getting more and more challenging. And we definitely hear lots and lots of stories of of folks who are buying based off of floating rate debt, at cap rates far below what the cost of that debt is. So, that leaves a big question mark, I think. But when it comes to what you were discussing in terms of the cost to build, so we actually just purchased a property where we bought it, basically from the developer as it was being developed. And so we went into contract months before, and we got a finished product for far below what it would cost to develop it today, right? And then when we factor in our lease up and so forth, we're getting it at about a 5% cap rate. And so those are kind of areas where in the real estate market, you're still able to find some sort of, edge, especially with such supply chain issues. But it definitely, we're seeing it nonstop, and I don't see it stopping anytime soon. So. Chris, were you going to say something?
Yeah, I was just going to say with the operators that we work with and those that we're exploring a lot of the similar conversations, right? That they're coming in with negative leverage with debt over the cap rates, hoping that growth, the rent growth is going to outpace, right?
Right.
But we're also seeing some changes in approach, right? So those value add operators are doing one of a few things. They're either putting in more equity, taking out less debt, right? Which only impacts the net return, the levered return, right? It lowers it. Right. We're also seeing sorry, just lost my mind there. Sorry, keep going. I forgot what I was gonna say.
No, 100%. I mean, so that's definitely something we're seeing, but we actually, we used to be heavy into value add deals, and we do not do value add deals anymore because we believe in the rent growth story so much that we don't necessarily believe you need to do value add to actually, you actually need to, so we renovate when we need to, we do light renovations and so forth, but we're actually purchasing more like class A, not luxury, but class A garden style apartments, and because we're able to get a similar, sometimes even higher yield, and the capex is much less, and there's the whole I mean, it just, we don't have to be dependent on a huge value add play. So I definitely, I hear that back in the days when we used to put in maybe 20% and do a heavy value add. I mean, there are still groups that are doing it, and I hope that they're successful with it, but it's definitely not what we're looking to do today. There are certain areas where we have been able to also find some sort of, edge where there are, let's say, tax abatements. So, we're purchasing a deal actually now. It's a class A deal, and there's a tax abatement, so it's going to allow us to get a relatively attractive 6.5 to 7% cash on cash day one type of return for several years. So there's all kinds of different areas where you can find it, but they're few and far in between. That's for sure.
And I think we to build out on that sort of value add challenges that some of the managers that we speak with are seeing. Even last summer, some of the issues were around just getting the appliances for a renovation. So if you were trying to do a class B to class A and you want to upgrade the appliances in a kitchen, well, you were really running into challenges just getting the supplies, just getting the new refrigerators. So,
right.
I taught, some people had different strategies about, well, we've been buying in bulk, and we've got a couple of warehouses, and we're storing it here, and we're, as we need them, because this is just going to be a challenge. I think, given both the war in Ukraine and the sort of slowdown in China, the lockdowns in Shanghai, the ports being pulled back, this is not going away anytime soon. And these supply chain factors are very much affecting real estate developers at whether it's a value add renovation to a ground up development. This is going to be an ongoing issue.
Yeah, 100%. Great. So I'm really interested to hear now, everybody put on their kind of wizard hats and their, let's hear some prophecies here about where are we headed. So we've said, we've discussed a little bit of the challenges where we are. We could go on. I mean, this could last for 3 hours just discussing about where we are, but unfortunately we don't have that amount of time right now. But I'd really like to hear, based off of your guys' experience and what you're hearing from your clients and from your circles, where are we headed? What should what should we expect? What should we do to prepare? So Loretta, what are you hearing? What are your clients doing to prepare? And what is kind of like the the thought in terms of where things are headed as of today?
I mean, I think the one thing that we need to all, okay, first of all, predicting interest rates are a fool's errand, but I am going to say interest rates are going up and they're going to keep going up. There is a forecast that, the Fed, they just did a 50 basis point. They're going to do another in June, probably do 200 is a good estimate for what they might do this year. Treasury yields hit 3% earlier this week. I don't see that going back down. And so all of that, increases the cost of capital and is going to create challenges for investors at, every asset class. But that's something that I think I'm gonna go on record and say I think interest rates are going up. We'll see. We'll see if I prove correct on that one.
Sure.
There was a period of time a couple of years ago where everyone said, "Oh yeah, rates are going up. Interest rates will go up this year," and then it didn't. And so it feels a little weird to even say it's happening. The other thing I want to mention is, for most people in the industry, this is our first sort of professional experience with inflation at this level. I mean, yes, I do know people who experienced it through the 70s and 80s and can talk about what they did to manage portfolios, but the vast majority of people in the industry, this is unprecedented. We've never been here before, and we're still sort of finding our way. So, what we'll do in this, I think it remains a little uncertain.
Yeah.
Yeah. I'm not to be doom and gloom, but when I look at, the past Fed tightening cycles, there have been 5 periods where unemployment was under 5%, inflation was over 4%. All 5 of those, a recession was within 2 years, and the Fed was unable to deliver a soft landing. So right now, the kind of cards the chips are stacked against them. Their track record's not always been the best. Right, I'm with Loretta. I see, 50 basis points in June and July. The Fed, based off of the last, the CPI this week coming in higher than expected. PPI this morning, which is purchasers index, coming in higher, which is a leading indicator for inflation, right? Indicating that inflation is going to be here to stay. I think that when you look at how you can combat inflation and you look at traditionally, tightening works. But when you look at today's environment, it's really hard to fix supply chain disruptions that are a result of a war and a pandemic that's still spiking in China. Monetary policy can't fix that. Yeah. And so odds are inflation will remain elevated for some period of time, and that descent back down into normalization is going to be long and arduous. Do we get back to the Fed's target of 2%? I mean, if you look at how the market is pricing in 10-year inflation, it's 2.5% to 3%. So we would argue that we may not get back to that 2% inflation target. I think that the Fed will continue to try and do everything it can to combat inflation. Typically, when the market is in correcting and falling, the Fed put, so to speak, when they come in and save the market, on average has been 24%. Peak to trough right now, we are just over 19% down on the S&P 500, just barely out of bear market territory. Right. Odds are the Fed will let this continue to go down before adding support to the equity markets. If you think about, if they cause a recession and unemployment doubles, so to 7%, that's 7% of the people that are unhappy, right? But everyone feels inflation. Everyone. Sure. And so it impacts so many more people, in the country. So the Fed is definitely convicted there, but I think the interest rates are definitely interesting. I would anticipate them to go up, but I'm really looking at the 10-year. And you look at the last 2 times that the 10-year has broached 3, that it meets resistance at 3.25. Mm-hmm. And so it got up to 3.18 or 3.2 earlier this week or late last week, and since receded back below 3, but that 3.25 is really where I'm looking at that resistance. And if it goes through there, then I'm not sure where it's going to go. I mean, mortgage rates are already up over 200 basis points year to date. and
Sure.
sitting around 5.2% on a 30-year. I know that's, again, not to be doom and gloom, but I'm not extremely optimistic as we look forward into the rest of the year.
Sure. No, so there's a school of thought which I find interesting. Obviously, inflation is, it's not good for any single individual, and it's painful for lots of people. But at the end of the day, there's a school of thought that says inflation is not a bad thing, especially in this environment where GDP is growing. The economy has grown in a pretty healthy way, and so basically, it's a function of just supply shortfalls, and it's the market saying that there is demand. We will buy. Like, there is demand. The economy has grown enough, and you just can't meet our needs. And so, it will continue to at least produce something, right? So it's not going to go into a flat, some sort of stagnation or something, because it's saying, can you please produce for us? So I just think that I don't know that I fully buy into that, but I do think that it's interesting. And basically what that school of thought says is that it's a clear result of shutdowns, right? You shut the economy down, and now the economy is coming back and saying, we've grown since the last 2 to 3 years, and we need you. And so, we need to consume, or we're going to consume. And so, there's a lot of, I shouldn't say a lot. There is a certain school of economists that say that it's a good, positive thing for inflation for a shorter period of time. And also, it's extreme right now, right? 8%, it's extreme. And it's starting. I think there are signs that it may be slowing down, so then it can go into some sort of, kind of equilibrium where it is healthy. I don't know the answer to that, but that could be optimistic.
Go ahead.
I would say, yeah, some of the signs that we're seeing are that it might be, some of these indicators are decelerating, but they're still growing, and it maybe just not growing as quickly. That isn't a pullback yet. And as Chris was talking, I do expect this tightening to be I don't know that they can thread the needle on a soft landing. And the coming out, I think it's actually very instructive to read some of what was said about the 70s and the early 80s. The tightening does work, as Chris mentioned, but the recession of those recessions of back to back in the early 80s, they were pretty brutal. That was a really serious sort of economic hit. It bounced back pretty quickly, and you saw the 80s turn things around. But
sure,
I think we could see some pretty severe issues. One of the things that does come up a lot, though, is, can real estate serve as an inflation hedge? Can tangible assets more broadly serve as an inflation hedge? And that is actually something that a lot of our investor readers are kind of very much concerned about, and very much kind of eager to see how that plays out. And I think the answer is yes, as long as rent growth stays strong, we should be able to see that sort of embedded value seen in a tangible asset, which is one of the advantages of alternatives from that perspective.
Sure, 100%. I also will just note that, if you're a long-term player and holder, you have a outsized advantage. So if you are able to hold assets and buy them even in this environment over the long term, you have an advantage over those who won't, or who don't have the patience, or whatever it may be. So, to the extent that we're like looking into the future and how this impacts multifamily, so us as a group, at least, we prefer always to be long-term on our investments. And now, particularly is a good time to do that, at least in the business plan. If the deal doesn't make sense in the long term, it's probably going to be a challenging deal. So
I'd also add, when we talk about rising interest rates, that also means rising mortgage rates for home buyers. And I think this is becoming a very challenging landscape for new home buyers in particular, or even people looking to move up in the home industry. We might be better off staying put. And so that's going to create additional demand for rental property, whether it's single family rental, multifamily, because people just aren't able to buy in this environment. If you want to talk about, mortgage rates going from 3% to 5% in a matter of months, very quickly, That can mean for your mortgage payment an increase of, say, up to 25% monthly payment change, and that is really going to keep people out of the buying market.
Yeah.
Right. Especially on the heels of 20% price growth, all right, over the last year. So yeah, you look at the home affordability, those are the two main variables that drive it, right? Is the price and the cost of debt. And both of those are extremely high. And so that's one of, when you look at, I think that's a huge tailwind for multifamily. But then one comment you made earlier, Loretta, that gives me concern is, with rent growth so high, at what point does rent affordability become less attractive than home affordability, right?
Well, and the other thing that our readers are bringing up around that question of affordability is, at what point will you see greater government intervention, rent control, and other sort of things set in to keep those rents from growing? That one of the big issues that comes up a lot is sort of different municipalities or different governments around the country have very different approaches to this. And you've got your sort of New York, San Francisco, some of these markets that have very strong rent control. Typically that hasn't been seen in the more Sunbelt markets, which have been so popular. But how many years of 25% rent growth before local politicians start being pressured to do something about it? So that's another thing that I think should always be something to be aware of, is, if rents grow too much and grow to a point that wages are not keeping up, what will be done to sort of control that growth from a policy perspective?
Yeah. I'll just mention that, kind of like looking in current and then in towards the future, something that I meant to mention before is that we are seeing in the real estate market now deals starting to fall out, which is, it can be a sign of, something much larger, and it could be a sign of people are getting a little bit of sense and rates are rising. And so, but there have been several instances that we have seen and that we've heard about and that we know of within the last 2 weeks, where people made extremely aggressive offers. And usually it's dependent on floating rate debt. And they either got retraded by their lender, or all of a sudden they realize that that just their business plan isn't making sense, and so deals are falling out. So it's yet to be seen if that's kind of like a short-term thing while things get settled and we see where rates kind of stabilize, if at all, or if it's going to lead to a broader kind of repricing of assets, which would not necessarily be a horrible thing, especially in my mind, given the fact that we know that rents are so are in such high demand. So I don't I think that it could still readjust in a stable way.
I've heard talking about what's happening just in the last 2 weeks. I have definitely heard that the sense right now is that lenders are in sort of a price discovery mode. And yeah, the very high LTV buyers have maybe pulled back a little bit out of the market. That somebody was talking about how you'd go in on a deal for a multifamily asset, and perhaps last year there'd be 20 plus buyers, and now it's 8 to 9 bids, which is still a competitive market with a lot of people coming in, but that some of the maybe most leveraged buyers have been knocked back out of position because of some of these debt changes.
Sure, 100%. I mean, we've seen it from multifamily to even there were some smaller retail deals that we were doing, and our interest rate. This is going back even a month and a half ago. Our interest rate went from, in the span of 3 weeks, from 3.85 to 4.6. So yeah, I mean, and so you can only imagine now today, when people made extremely that was on a refinance. This is when people are going in and purchasing on extremely aggressive business plans, and all of a sudden their rate they see, which is going to be floating, and there's one way that it seems to be floating, which is up. So it is causing certain transactions to either retrade and get price reductions, or to fall out of contract completely. Yeah. So with all of this, any other thoughts from you guys? I just want real quick, actually, before we go on, we're going to open up a Q&A. very shortly here. So I just want to remind all the participants, we have a couple questions. If anybody has any additional questions, please put them in the chat, and we'd love to, try and address every question that we can. Any other final thoughts from you guys, kind of how to navigate what you're hearing from your clients, or what your maybe suggestions to your clients in terms of asset allocation, investments, navigating for the future?
Yeah, I mean, we're communicating that you look forward, right? We've been pulling forward returns for so long that you look at capital market assumptions looking forward, and it all points to lower return expectations across every asset class, even alternatives. And so to really start getting that expectation in line now, right? So that is expected, and to be long-term investors, not make knee-jerk emotional reactions, to stay invested, don't capitulate and sell and go all to cash, because there's a lot of things that happen. There's a psychological barrier that you're never going to get back in, because when it does rally, oh, you missed the rally, so you're going to wait for a correction that never happens, right? Or you miss the recovery altogether, because by and large, the best days tend to be within 2 weeks of the worst days. So, if you're in public markets, stay invested. If you're in high quality alternatives, granted, you don't get a lot of liquidity, but if you do, stay invested, right? I think alternatives do a great job of instilling positive investor behavior, and that's not selling.
Right.
It's certainly much harder to sell a physical asset than a stock, which would be one of the reasons why private markets are a little less volatile pricing. I would say that, in talking with people in the industry, the mood is still, it's not negative. Yes, there are concerns. Yes, we're in some really unprecedented times. Yes, we're not sure what's going to happen in the year ahead, but the mood is still, sort of cautiously optimistic. I think people feel good about the real estate asset class. And, I think there's still a lot of positivity in the market. Not the sort of irrational exuberance, except in maybe certain pockets, but I think people still feel good about real estate as an asset class overall.
Agree completely.
Yeah. Okay, great. Okay, thanks. All right, so we are going to open it up now to some Q&A. We have some questions coming in, and here we go. One is, where do you expect cap rates to be in 2 to 3 years from now? Would either, which one, who, Chris or Loretta, would it, please?
I'm not going to touch that one. I think just as I made the mistake of making an interest rate forecast, I'm gonna avoid making a cap rate forecast. I do think that we're gonna see. Now I'm gonna make a forecast. I do think we'll see some widening. We've seen some real compression for prime assets. I think we might see a little bit of widening there, but I actually would be surprised if cap rates gapped out considerably, just because the market has seemed to shake off a lot of stuff over the last 5 to 10 years. So okay. I'm not making a forecast.
Right. I'm not to piggyback off Loretta, but I'm in the same boat. I think there will be a little widening, but not to the extent that I think some analysts are projecting. I'm in the camp that I don't think the Fed's going to be able to tighten as much as they would like to. That's why I think they're trying to front load with rates today. But they're not going to be able to unload that balance sheet. They're talking 95 trillion or billion a month in 3 months from now. I see them having to reverse course sooner than later, which I think will also be a catalyst for activity as well. Okay,
great, thanks. Okay, our approach generally on cap rates is, we're not in the business of predicting. We're in the business of strategizing what we do in any scenario. So it very well, cap rates could expand. We believe that rents will support it and still keep the values up, maybe not to the extent that they were right now, but they will still remain high because of the demand and everything else that we discussed. So, I have no idea if there'll be, selling multifamily properties at 2 and 3 caps, like what was happening about a month ago. But even if it's at a 5 or 6 cap, which once upon a time was, unimaginable, or even, above that, we feel that over the long-term rents, especially in the multifamily space, rents will justify and will kind of move in correlation to those cap rates. Okay, let's see here. What are some of the implications that you see from the Ukraine war on these issues, and particularly real estate?
Well, I mean, I'm gonna say, the first thing that we've seen is the cost of energy, the impact there. It continues to be felt, and so that has a knock-on effect broadly, and it's also sort of broader supply chain issues, food costs, energy costs, everything going up, and it's just sort of driving this inflation picture, which then pushes the Fed to act.
Mm-hmm. Yep, 100%.
Yep.
Chris, any thoughts from your end?
I mean, I would only add that, from an economic perspective only, fortunately, that we're not too impacted, right?
Right.
That if we were in Europe, I think that the impact would be significantly worse.
Sure.
But yeah, I think mainly here it's mostly energy related.
Okay, yeah. So we were thinking about this, and there's some areas that we feel it may impact the real estate sector, and in some ways it actually gives a boost or a push to some of the economic factors. One is defense spending. So in certain markets where there's a heavy emphasis on defense, we feel that that's going to be something that, especially to the extent that this continues, and this and then another thing, obviously, that, like you've said, so there's energy and oil, but what we're seeing is that so Europe is going to go away from Russian oil, which means that US, which is a major producer, is going to have more demand to produce that oil, and especially in areas where there's either alternative energy and also natural gas and fracking. So certain markets, real estate markets within those kind of fracking regions, particularly Dallas, Denver, Pittsburgh, those types of areas, it could increase the economic demands of those areas, and actually could be a boost. And there's other things that you mentioned as well, agricultural products and so forth, that will that the US is basically going to have to produce more in order to serve more of Europe. So that's that's something that we've kind of discussed internally. Very good. Okay, let's see some more questions here. Standing on the sidelines until this passes is a strategy. In what cases would this be a good versus a bad strategy? Standing on the side. So I think we discussed it a little bit before, but I don't know. I mean, Chris, maybe in terms of your clients and what you guys are suggesting to them, given the current environment. I know you said before there had been a certain sentiment of save some cash. Is that still the sentiment, or is now the sentiment?
Well, and that's more for public markets, right? If for those allocations earmarked for alternatives, one of the reasons that we want alternative exposure is that, one, you have an uncorrelated return. And then also, especially when we look at real estate and a lot of private credit, they're great inflationary hedges or hedges against rising interest rates. And so while we're anticipating lower expected returns, we still are forecasting positive returns. And still you're getting that inflationary hedge. So I actually think even a 10% return on real estate is better than losing 7-8% due to inflation sitting in cash, because it's essentially burning money. So I think it really comes down to security selection, and just expecting perhaps a lower return, but and very selective. I think one investor, especially with real estate, that unfortunately may not have that same luxury, are those 1031 exchange individuals, right? Where by and large, they have two choices. It's we're going to pay the piper, being the IRS, or we're going to, kind of take what the operator that we're invested in gives us, which, may or may not be a great opportunity. And so I feel they're at the, kind of biggest, paradox, from a decision-making perspective.
Yeah. Cool. Loretta, you have any?
Yeah, I would add, just from the institutional perspective, when I speak with investors, there's very much a feeling that it isn't really possible to sort of time the market. That, if you believe in the real estate asset class, if you have decided to allocate some portion of your portfolio to real estate, then you should stay invested to it. Kind of while there is some movement at the margins tactically, generally you make the commitment, you stay in the market, just because timing the market, especially for some of these institutions which move very slowly, Chris has the advantage of working with more of an endowment speed. Some of these bigger institutions, the insurance, the pension funds, it's a little bit more like trying to navigate with a cruise ship. They do not turn nimbly. So it does make more sense to just sort of, stick to your strategy and follow forward, is generally sort of how institutions approach this.
Great. Okay. I'm going to make this the last one, the last question. So there's a lot of doom and gloom out there. And how much of this is real concern versus just media sensationalism, if I pronounce that right, in terms of the current economic cycle. So
as a member of the media, I'll jump in first.
Yes, please. Exactly.
I think there is a fair amount of sensationalism generally. We do try to avoid it in our publications, but it is sometimes unavoidable. I do think that some of the doom and gloom that we're seeing reflects real concern. We are facing fairly unprecedented times, and there are a lot of risks in the market. And many of these risks are ones that people in the market have not dealt with before. Is it being sensationalized? Maybe a little bit.
Very good. Chris, any thoughts from your end?
Bad news sells, right?
Right. Those clicks are so good.
Right. And they go up exponentially with the bad news over the good news, right? No, I do think there's like Loretta, there's definitely some sensationalism going on there. I've already said, not to be too doom and gloom. I think that you look out 6 to 9 months, I'm not too optimistic on the outlook, and even if we do experience a recession, I would anticipate it'd be a very shallow and short-lived recession. You look at even just home buyers today versus the great financial crisis. If we do have a financial recession again, they were looking at negative equity in their homes when that started, right? Using it as an ATM. Right. Today, they're sitting on 50-60% equity in their homes. So they have a huge cushion. And they by and large, their balance sheets are significantly stronger than they were. And if we do experience some sort of recession, I would anticipate it'd be very short-lived and shallow. But, like Laura said, we're on unprecedented times, and a lot of us have never dealt with this in our career. And so it's, I think, staying level-headed and, cool heads prevail, and don't make knee-jerk reactions. So.
Cool. Very good. Okay. Well, we want to be mindful of everybody's time. Do you guys have any parting words before we say goodbye?
Just thank you for letting me join, and thanks everyone. This has been a great experience.
Yep.
Thank you very much.
Yeah, thank you very much, Daniel. Loretta was great, and HLC, thank you.
Thank you for joining, and thanks for all our participants and attendees, and hopefully we'll see you soon. And again, this is part of an entire series on our website. We have much more content dealing with these matters, graphs and statistics and all kinds of great stuff that the team has put together. So please feel free to join there, and we look forward to seeing you next time. Thanks, everybody.